Most people think that when the economy crashes, the rich lose just like everyone else. But here's the shocking truth. The wealthiest individuals often make more money during a recession than in a booming market. In fact, studies show that billionaires have seen their wealth increase by over 500% during market crashes, while the rest of us are struggling to stay afloat. How is this possible? It's all about how they play the game. While many are panicking and selling off their investments, the rich know how to turn fear into fortune. They don't just survive economic downturns, they thrive in them. In this video, we're going to dive into the secret strategies that allow the rich to get richer with every economic collapse. From buying distressed assets at rock-bottom prices to using cash flow to build lasting wealth, you'll discover the steps the wealthy take when the market crashes. Stick around to learn how they build their financial empires in ways that most people would never even think of. Chapter 1. The Hidden Power of Panic. Turning fear into fortune. Economic collapses spark panic, but for the wealthy, panic is often the key to massive profits. When markets are tumbling, stocks and assets are sold off at steep discounts, opening up opportunities for value investors. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This is the essence of how the rich grow their wealth during downturns. During the 2008 financial crisis, Buffett bought preferred stocks in Goldman Sachs and General Electric, making billions. The key here is seeing value where others see risk. While average investors sell off in fear, the rich use this time to buy great companies at a bargain. Remember, fear causes stocks to drop, not the company's intrinsic value. This gives value investors an edge. Historically, the market tends to bounce back, and those who buy at the bottom often enjoy massive returns. In fact, over the last 50 years, the average stock market return post-crisis has been over 10% annually. For the wealthy, this isn't luck, it's strategy. They know that the fear of others is a source of opportunity for them. Chapter 2. Crash-proof strategies. How the wealthy build a fortress portfolio. When the economy crumbles, the rich aren't worried, they're ready. One of the strategies they use is to have a fortress portfolio, a mix of safe, steady investments like dividend-paying stocks, gold, and real estate. During a downturn, these assets tend to weather the storm better than high-growth stocks. Take utilities, for example. These companies provide essential services, and demand for their products doesn't change much during a recession. The rich also diversify globally, ensuring their investments are spread across multiple economies. Real estate is another favorite of the wealthy because it provides passive income through rental properties. They've mastered the art of generating cash flow during times when most others are seeing their portfolios shrink. The rich also know that recessions often create buying opportunities in these sectors. Cash reserves are essential for buying these assets when prices drop. Without them, it's impossible to act fast. And let's not forget bonds. High-quality bonds, especially U.S. Treasury bonds, are often seen as a safe haven during turbulent times. In fact, during the 2008 crash, while stocks were falling, bonds surged. This is why the wealthy keep a large portion of their wealth in such assets. Chapter 3. The secret to buying low and selling high, but in reverse. The secret to making money in a crisis is not just about buying low and selling high, it's about doing it in reverse. During economic booms, the rich often sell off overvalued stocks and hold cash. When the market crashes, they use their cash to buy undervalued assets at rock-bottom prices. Most investors panic and sell, fearing further losses. But the wealthy know that market downturns are often temporary. They see an economic collapse as an opportunity to buy quality companies at a huge discount. This strategy is often overlooked by retail investors who fear the worst during market drops. Take Buffett again, who famously bought during the market downturns of 2008, making significant moves while others were selling out of fear. His ability to stay patient and wait for the right moment allowed him to buy undervalued stocks that would later appreciate in value. Over time, this strategy compounds. In the 1970s, during the oil crisis, the market dropped, but many of the wealthiest investors made their fortunes by capitalizing on the drop in stock prices. If you're finding this content useful, don't forget to hit the subscribe button for more valuable tips on growing your wealth and mastering value investing. Chapter 4. From crisis to cash flow. leveraging downturns for passive income. When the market collapses, the rich don't just look for gains, they look for income. By investing in income-generating assets, such as rental properties and dividend stocks, the wealthy secure consistent cash flow, even in the worst of times. Real estate, for instance, is one of the richest sources of passive income. During the 2008 housing crisis, many wealthy individuals scooped up real estate at incredibly low prices, increasing their rental portfolios. According to a report by the National Association of Realtors, the median price of homes dropped by 30% during the crisis, making it an ideal time for the rich to buy. Additionally, dividend-paying stocks continue to produce cash flow even during market downturns. Companies like Coca-Cola and Johnson & Johnson raised their dividends consistently during past recessions. For the wealthy, this is a crucial part of their strategy. The cash flow from these investments allows them to reinvest and grow their wealth, without needing to rely on the market's ups and downs. Another key asset for generating passive income during downturns is bonds. Wealthy investors often hold a portion of their portfolio in high-yield bonds that offer stable returns. Chapter 5. The Contrarian Mindset. How the rich think differently in crisis. When the economy crashes, the wealthy don't just see disaster, they see opportunity. They possess what's called a contrarian mindset. This means they often invest in areas that others avoid, especially when the majority are panicking. Contrarians thrive in times of market stress because they understand that most investors act emotionally, not rationally. Take George Soros, for example. In 1992, during the British pound crisis, Soros bet against the currency and made over $1 billion in profit. It's not about predicting the future, it's about understanding when the majority of investors are wrong. During times of crisis, the rich don't follow the herd, they take calculated risks when others are paralyzed by fear. Even during the Great Depression, people like John D. Rockefeller saw great opportunity in stocks and oil. Rockefeller famously said, "The time to buy is when there's blood in the streets," highlighting how wealth is often built in the darkest times. The key for the wealthy is to remain calm, take a step back, and look for value where everyone else sees disaster. Chapter 6. The Untold Secret. Why the rich make more during a crash than in bull markets. What's truly remarkable is how the rich make more money during a crash than they do in bull markets. This isn't just because of the assets they buy, it's because they leverage their wealth to acquire distressed assets faster than anyone else. During market crashes, banks and other institutions are often forced to sell assets at discounted prices. The wealthy use their access to capital to scoop up these assets before anyone else can. According to data from the Federal Reserve, the wealthiest 1% of Americans saw their wealth grow by 500% during the 2008 recession, while the rest of the population barely broke even. Why? They understood that recessions create opportunities for those who are ready to act. They also know how to access capital quickly. When everyone else is scrambling, the wealthy can get loans at low interest rates and buy assets that will later appreciate. For example, the real estate market in 2008 was flooded with distressed properties, and the wealthy capitalized on the opportunity to purchase them at steep discounts. The cycle of buying low, holding, and then selling high when the market recovers is how the rich continue to grow their wealth, even in tough times. Don't forget to subscribe for more insights into how the rich get richer, even when the economy is in turmoil.